Hello everyone. Now we will solve problem number 28 from chapter 13. So if you read the problem, you will see that the company that is to be liquidated, they listed all of their liabilities, and at the same time they listed all of their assets, and you know what are the book values and what are the fair values. So the question is, how much money will the holders of the notes payable collect following liquidation? So now what we will do, first we'll try to figure out what are the free assets, and then we'll also check our liabilities. We'll first see what are the liabilities with priority, and then we'll check how much free assets we need to pay all those liabilities with priority, and then we'll check what are the unsecured liabilities and what portion of free cash or free assets we actually have, and what percentage of unsecured liabilities we can pay based on the free cash or free assets that we have. So let's solve it. First, let's see what are the free assets. So here you will see that when you look at this liability list, you will see that you have one liability, notes payable. It is secured by land. And then if you look at the value of the land, of course we'll focus only on the fair values, because book doesn't matter here. When we'll sell the assets, we are expecting to receive as per the fair values. So this piece of land is used to secure the notes payable, and look at the amount of notes payable, which is 120,000, and on the other hand land value is 90,000. That means this land is actually partially securing the notes payable. So after using the land which is used to secure the notes payable, we will get nothing from this land. Now how about the current assets? Yes, we have current assets, and of course we will consider the fair values, and that may include cash, account receivables, inventories, and we have buildings and equipments. So that means we'll check what are the free assets. So we have current assets, which is $35,000. We also have building and equipment, which is $110,000. So if you add these two, you will find our free assets, and the total free assets is 35 plus 110. It's actually $145,000. Now we will check how we'll pay our liabilities. So when you read the chapter, you learn that there are some liabilities that must be paid with priority. For example, administrative expenses, customer deposits, salaries payable, and of course income tax. Well, for salaries payable and customer deposit, we have certain limits. So now look at the liabilities. We have income tax, we have salaries payable, we have administrative expenses which occurred during the period of liquidation. So we must need to pay these liabilities first. So you call it liabilities with priority. So let's check how much is it. Liabilities with priority. So we'll consider this all three items: income tax, income taxes, which is $8,000. Then we have salaries payable. Well, the limit is up to $12,850, and we have 2 employees, and of course it's less than the limit, so we have to pay the whole thing. So salaries payable, which is $6,000. And then we have administrative expenses for liquidation, so we'll also pay that one. Which is the administrative expense, which is $20,000. So these liabilities you must need to pay first. So here if you add all that 8, 6 and 20, it is actually $34,000. So now after paying these liabilities with priority, let's check what's the amount of free assets. So free assets, I'll write it down, free assets after paying liabilities with priority is the difference between these two. That means $145,000 minus $34,000, which is, if you take your calculator, and you will find that it is $111,000. Now we will check what are the other liabilities. Of course, we have notes payable, but remember, total amount is 120,000, so 90,000 up to 90,000 is backed up by the land, so 90,000 is secured portion of notes payable. So the rest, that means 120,000 minus 19,000, that's the unsecured part. We have accounts payable, which is also an unsecured liabilities, and we have bonds payable. So now we will check what are the unsecured liabilities. So we have notes payable, again the portion which is not backed up or secured by land. So here notes payable, I just mentioned the total amount is 120, up to 90% is secured by land, so the rest is not secured. So 120,000 minus 90,000, which means $30,000. And we have the other item, accounts payable, which is not at all secured. So we will write that one out, accounts payable, which is $85,000. If you want to say it here, accounts payable 85,000, bonds payable 70,000. So let's write it, accounts payable 85,000 and bonds payable 70,000. So what's the total amount of unsecured liability? So if you add it, 30 plus 85 plus 70, I have my calculator and you can do it quickly. It's actually $185,000. So now remember, this is the one portion that we need to pay, but those are not secured. Now look at the free assets. How much free assets we actually have? So we actually have total free assets, which is here, total free assets, which is, we did it here, $111,000, and then we have this unsecured portion of liabilities, which is $185,000. That means our free assets, that's not enough to cover up all these unsecured liabilities. So we'll just check what percentage of unsecured liabilities can be paid using this amount. That means let's calculate the percentage. So if you do a little maths, 111,000 over 185,000, so we get here 60%, 0.6, right? 0.6 or 60%. That means we will allocate these free assets among this unsecured liability proportionately. That means all these three unsecured liabilities will be paid up to 60%. Use this $111,000. So the question was, how much money will the notes payable holder will get? So here, if you go up, notes payable, basically they will get $90,000 from this land, and then out of the rest, out of this rest amount, 30,000, they will get only 60%. That means payment on notes payable, it will be here, of course, the land, which is used as a security, 90,000 plus this unsecured portion 30,000, but only 60% will be paid. So take 60% of 30,000, which is $18,000 if you do this little math, and then they will of course get these 90,000 from the land. So total, the answer is that the notes payable holders will be able to get $108,000. So this is the problem, and I hope you will understand it.